Let's stop pretending this is fine. The labor force survey for August 2025 just dropped, and here's the headline. Canada lost 66,000 jobs last month and 107,000 jobs in 2 months. Not in niche industries, not seasonal blips, but in the pillars of our economy: construction, manufacturing, and retail. If you think that paints a healthy picture, you're reading the wrong coloring book. Construction jobs crushed, housing starts stalling, and trades are sitting idle. Manufacturing is bleeding, exports soft, plants scaling back shifts, and retail has been gutted. Canadians are maxed out on credit, shopping less while stores cut hours and staff. These aren't just numbers. These are families without paychecks. And when Canadians stop spending, confidence tanks and the whole system spirals. Consumer sentiment at multi-year lows. Why? Canadians are stressed out about three things: job security, there is no confidence their paychecks will keep coming; debt obligations, higher interest rates are eating disposable income alive; and future big purchases, cars, homes, renovations, all deferred. That's not resilience. That's fear in the bloodstream of the economy. Remember the elbows up economic rallying cry after April's election? The idea that grit and grind would push Canada through this challenge? Well, the elbows are up, but the scoreboard is showing we're losing. 107,000 jobs lost in 2 months. Confidence falling, growth flat. If this is a fight, Canada's bleeding out in the first few rounds. And here's the canary in the coal mine: accounting firms. When the big four, KPMG, Deloitte, E&Y, PwC, stop hiring and start cutting, it's not just about their staffs. It's about what they're seeing inside their clients' files: slowing corporate revenues, fewer deals and IPOs, companies tightening budgets, delaying audits, scaling back projects. In recent months, all four have trimmed staff across Canada. That's the financial world quietly saying, brace yourself, the slowdown is here. If accountants who profit on the success and growth of businesses are nervous, you should be too. Now tie it back to housing. Fewer jobs equals weaker demand. Lower confidence equals fewer buyers. Rising EI claims, already over 500,000 Canadians this year, equals households struggling with mortgages. This doesn't just nudge home values down, it slams them with psychological weight. Buyers retreat, sellers panic, and lenders get cautious. When three major sectors soften at once, you don't just get a slowdown, you get a labor market recession. The most recent Edge report shows what's bubbling under the surface. Canadians out of work longer than 6 months are rising. Long-term unemployment is back. Over 500,000 Canadians have been receiving EI since January. That's not a blip. That's 500,000 people relying on benefits to get by. When EI claims swell, it's the economy's way of waving red flag. Recession risk is rising. Here's the kicker: EI isn't infinite. The longer people stay unemployed, the harder it is to get back into the labor force. Skills erode, confidence erodes, and the entire community weakens. A client who runs a framing crew in Vaughan told me they haven't had consistent work since March. Every project got pushed or canceled. These are guys who built half of GTA's skyline, and now they're waiting and praying for callbacks. A concerned retail manager client mentioned they used to carry 40 staff. They're down to 25. People leaving shifts begging for overtime. Another client, a welder in Hamilton, shared that his plant just cut a shift. Half the crew is on EI, first time in his 20 years working there. These aren't statistical quirks. They're Canadian families. A soft labor market isn't just bad for the unemployed, it's bad for everyone. Housing demand falls, fewer buyers, more forced sellers, pressure on already fragile home values. Government revenues shrink, less income tax equals more deficits. Guess what fills the gap? Higher taxes later. Consumer confidence dies. When your neighbor loses their job, you don't buy that new car. You don't renovate. You don't sit tight. Here's the truth. Canada's in trouble. The labor market is softening, confidence is fading, and even the big four accounting firms are blinking red. Expect more job losses through Q4. Expect unemployment to climb and expect confidence to erode further. Once accounting firms, once banks, once corporate advisory teams start cutting, this isn't about leading indicators. This is the storm itself. This is how economies stall. This is how recessions deepen. Politicians will point to job growth numbers padded by public service hiring. But how sustainable is that? You can't run an economy where government is the only employer growing. That's called a Ponzi scheme of payroll. Eventually, the math doesn't work. And when the private sector weakens while the public sector bloats, taxpayers carry the bill, while also carrying higher mortgages, higher rent, and higher debt. Expect unemployment to rise. Expect job seekers over 6 months to keep climbing, and expect household budgets to snap when debt, inflation, and job insecurities collide. This isn't doom mongering, it's straight math. You can't have 500,000 Canadians on EI in August and pretend we're in a healthy cycle. If you're a homeowner, or you want to be, you need to play defense. Shore up your savings. Reduce debt. Don't assume your job is bulletproof. And don't wait until renewal day to talk strategy. We can't keep blaming global winds or bad luck. This is a Canadian-made mess. If you're worried about your mortgage, your renewal, or your next move, don't wait. Talk to us at OwlMortgage.ca. Like this video, share it. Drop a comment. Have you or someone you know been hit by layoffs recently? Let's bring real stories forward, because the headlines don't seem to be telling the truth. I'm Vince Gaetano. This is OwlMortgage.ca, and this is the wake-up call Canadians need. See you next time.